Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our periodic commentary on market and economic events. Let's get started. So far during 2023, investors have been playing essentially a game of chicken with the Fed. The Fed is making it very clear that they're worried about how strong the job market is and how that might elevate inflation. And that could mean that they're going to keep raising rates. Investors, by contrast, have been looking at the economy. And after worrying that we could slip into recession, they're starting to say, you know what? The economy might be looking a lot better than we expected. Certainly a lot better than I expected after all the interest rate increases that we've endured. Sure, housing is having some serious problems, and there are other interest rate sensitive sectors of the economy that are struggling, but the job market continues to be extraordinary. Now, the January non-farm payroll blew everyone away with 500,000 job gains. Now, I'm going to argue that a lot of that is what is called seasonality. See, economists don't want to just give you the numbers as they come out of the economy. They want to seasonally adjust it. So they take into account the fact that normally in January, a lot of people who were hired for the Christmas rush, they lose their jobs. A lot of waiters and service people that were all brought in for the Christmas holidays, they all lose their jobs. None of that happened this year. The seasonal adjustments were totally wrong, and that meant that it elevated the job gains significantly. And does that mean that the job market isn't as strong as 500,000 job gains would say? Probably. But that doesn't mean that the job market isn't unbelievably, amazingly strong. As a matter of fact, they revised all of last year's numbers. And we thought last year was a great year for the job market, added 3.5 million jobs. Turns out we added closer to 4.5 million. Now, investors looked at that and they said the economy is doing way better than we thought. Then we got numbers on retail sales. We got numbers on credit card balances that showed how spunky consumers were feeling about spending. And investors said, doesn't look like a recession to us, quite the opposite. Let's bid up stocks. There's a problem with that. And that is that this good news on the economy, the Federal Reserve is not seeing necessarily as good news. They raised those interest rates because they wanted to slow the economy down. And they particularly wanted to slow down the job market. And that doesn't appear to be happening. And today we just got more inflation data that was disappointing. And that inflation data suggested that price pressures are slowing, but they have stopped accelerating down. They've sort of like started to really moderate their pace of slowing. Now, I'm going to go back to that seasonal adjustment thing. Normally in January, Walmart, Target, all these people have leftover Christmas inventory and they have to start cutting prices to get people to come in. So the seasonal adjustment factors expect prices to decline. But that didn't happen this year because people were cautious going into Christmas because they kept hearing about recession. And then nothing bad happened. And so in January, they went out and spent in ways that normally don't happen. And so they weren't expected for the seasonal adjustments. I think the inflation picture still looks really, really good. And so, but for the Federal Reserve, they're seeing numbers that look concerning. And here's where that playing chicken with the Federal Reserve. Investors, by driving up the stock market, are saying we're looking at great looking economic data. We're looking at inflation data that's getting better, maybe not as fast as we were hoping, but it's definitely getting better. And so we're ready to buy. And they're kind of ignoring the fact that the Federal Reserve is saying we are ready to tighten significantly more if we do not see the changes in the job market and in the inflation picture that we want to see. Now, we wrote a grim outlook for 2023 because we felt like the Fed was going to just keep on tightening until something broke. And our optimistic sort of how do we get out of jail? What's the thing that can happen that can prevent, the Fed tightening until something breaks? And that would be really good news on inflation early in the year that kind of, takes some of the wind out of the sails of the Fed wanting to tighten, clear signs that there's job market moderation. None of that's happening. Quite the opposite of that is happening. And so we find ourselves in this weird position where we totally agree with the investors who are wanting to buy stocks because the economy looks much better than we thought, and we are still completely convinced that inflation is going to continue to come down. And as a matter of fact, there's baked in the cake drops in CPI just because of housing data. Housing data in the CPI is lagged almost a year. So the big inflation you saw in housing in January actually reflected what was happening in the housing market a year ago. And we are going to see a huge drop in housing inflation, almost guaranteed, over the next 12 months. And if nothing else spikes up in the inflation picture, we're going to be at about a 2% CPI core, the Fed's target, by the end of the year. Combine that with great job market. Employers don't want to lay off people. They love their employees because they realized when they couldn't hire enough how valuable they are. This is such a great story for the economy. We agree with what the investors are wanting to feel about the economy. But our number one rule is don't fight the Fed. And the doves on the Federal Reserve who are hoping to get good news on inflation and softening in the job market early in the year so they could argue, let's slow down the tightening. Let's wait and see what the tightening we've already done is going to do. They have had their teeth pulled. They are, sidelined. And the hawks who want to keep tightening, they have gotten all the ammo they need to keep that relentless tightening drive going. And so as much as we agree with the sentiments underneath this rally, and we agree with the economic assessment, our opinion and ultimately investors' opinions don't matter. What matters is the opinion at the Federal Reserve, and the Federal Reserve hawks are in control. They're getting all the ammo they need to keep tightening. And when the Fed keeps tightening, ultimately, the good news that's driving stocks higher turns bad. Thanks for joining us for Market Insights. We hope you found it informative. If you did, we hope you can like the video and share it with your friends. If you'd like to see more of our research, you can find it at caravelconcepts.com. And you can also learn more about our integrated portfolio management and financial planning software systems. Thanks.